All right. All right, we'll get started. Thank you, everyone, for joining here today. I created a PowerPoint presentation. I'm going to work off of this. And instead of PowerPoint for my PowerPoint presentation, I use Google Docs. Instead of showing it, I'm just going to use it as a cheat sheet for myself. And the first thing that I wrote down in my head was that we need to do the belief of the week, because I didn't write that down on my sheet here. So the belief of the week is caring. What's that have to do with small business accounting?
All of our customers care about their
You gotta care enough to get it right.
Yeah, we need to care enough to get it right so that we're not constantly reworking things or telling our developers to do the wrong thing when we're building accounting systems or integrations with accounting systems.
It's good. Yeah, our customers absolutely care about their money, most of them.
Yep.
So if we're helping them with their systems, and forget about the cost of what we're doing, most of the time, whatever we're building touches financials in some way that's not, it may not be direct, may not be a direct integration, but it has to do with sales, purchasing, inventory, quoting, operations, everything ultimately hits finances. So I was, so I taught college for years. 2002, I taught my first college course. And I have told some of you this, but I was teaching at Mercer County Community College. And I go into a class, I was teaching Saturday morning class, and it was in environmental studies. And Saturday morning at 8 o'clock in the morning. So I show up, I'm going to say unaffected. I was 27 years old. And do you know who takes Saturday morning environmental studies courses? People that absolutely have to.
Yeah.
That also can't work, they can't attend courses during the week. So it was, apparently this was a required course for paralegals. And the people who were in the paralegal program at Mercer County College were primarily people who had jobs during the week, and it was a class of, I think, 15 people, and 14 of them were women, and 15 of them were older than me. So I'm 27 years old, and the average age of the class is probably 50, 55 years old, people that are just going to school for this and couldn't take it during the week. So I taught this course, and about halfway through, this nice lady, she raised her hand. She's like, I have a question. What's your question? How old are you? And I told her apparently that was been going on in class. How old I was. So why do I bring that up? Because I learned that that the first thing you're supposed to do when you give a speech or teach a course or do anything like that, you're supposed to provide the credentials. So why should anyone listen to you? If you don't explain who you are and why people should listen to you, then you're not going to. Then there's no point in trying to capture attention, because people might think they already know more than you, or they just don't believe what you're saying. So I'll start off with my credentials in accounting, and it starts off here at Miles Technology. The day I interviewed with Chris Miles. Sent my resume, and I was super excited. I went to the old building there, and Chris asked me a question. He said, John, what is accounts receivable? Pretty straightforward question here, right? Most people sure could answer that. So I said something along the lines of, oh, it's when you get accounts, you receive that. So, yeah, probably part of the sales process. He's like, nope. He asked me the next question, and he says, okay, what's a general ledger? Diary. Nope. And he asked me 4 or 5 more questions, and the answer, his responses went from nope to not even close, no way. So I left there, assuming that I was going to keep the job that I had before I worked here. But amazingly, I was hired. And I don't know if it was a good thing or not a good thing, but one of the first projects that I independently worked on was an accounting integration project. And this is in the days of time and materials. And what we did is we sold a project similar to what we do today, and it was a simple, they had an existing system, and they wanted wanted to create a text export, an IIF file into their QuickBooks. Seems relatively straightforward. They gave an estimate of $2,500. I still remember for this project. And me, superhero person knows nothing about accounting, comes to the rescue. So I come in and very simple text export. How hard can that be? And create an export file. And let's fast forward 3 weeks, $20,000 later, customers just getting invoices. As you can imagine, their anger that they got invoiced $20,000 for a $2,500 project. And it was primarily because every time they tried to import this file, there were things that were out of bounds. So that went horribly, and I said to myself, I'm never ever going to work in accounting again. This is the most convoluted, difficult, nonsensical thing I've ever heard of. I know how much is in my bank account, but I don't know what asset liability these different types of accounts are. So I feel like I've adequately given you my credentials as to why I should be up here talking to you about it. But what happened is after that, I realized that if I'm going to succeed in this type of work, working with businesses, I need to understand accounting. So I asked lots of questions, worked on more projects, made more horrible failures when it came to building an inventory system. I have failure after failure of accounting projects in my early career here at Miles, including something that I've done, and unfortunately I've seen us do this 4 or 5 times after I made this mistake. But there was an example where we're migrating, we did a project to migrate QuickBooks file to another QuickBooks file. Relatively straightforward, really big file. Wanted to migrate the history from an old QuickBooks file to a new QuickBooks file because it was breaking and things like that, so we had to build scripts to migrate it over. So anyone here want to take a quick guess as to how much that project cost?
A lot.
A lot?
Yeah.
To me, $50 is a lot.
All right, I'm gonna go with $15,000.
$15,000. Anyone want to go up or down from that? 5,000? Anyone want to go lower? 50. 50. We have a 50. The final invoice was $95,000, and the customer thought it was going to be $15,000. Again, but this was the actual amount of work, and it wasn't just me in this case. It was me and JP and Pinky and 3 other leads working overnight to get this done, because it had to be done by a certain date. And that was another example of a project that I took on where I just didn't know the complexity of what I was getting into. There was another project that we worked on. We built a system that, again, had an accounting integration using QuickBooks SDK. And what I didn't understand at this point was the super critical importance of the difference between inventory and non-inventory items. When you're doing an integration with QuickBooks, you have to recognize whether something's an inventory item or not inventory item, because it has a completely different set of impact on the financials, and didn't understand that. I had no clue what happened. So after we went live, unfortunately it was a couple of weeks or maybe even a month after we went live, and the owner of the company ran his books, and everything was just a huge mess because I didn't understand that. So I don't joke when I say I made failure after failure in terms of working on accounting systems, and each time I learned something new. Every time I figured out what is it that needs to happen here? Why is inventory different? What is important about creating IF files if we're doing integrations? And soon I really learned about how to do this. I did multiple migrations from different systems, different accounting systems. I worked on a whole lot of integration projects, and for a while here, for even a couple of years, we had a group, a division that was the Accounting Solutions Division. We implemented SAP and Great Plains and QuickBooks, and I led that group, and we implemented systems until we decided that we didn't want to implement other people's software. So I was involved, as some of you know, in the Striven team, and helped design the accounting module that we built. So I have gone from knowing absolutely nothing about accounting, literally nothing about accounting, not even T-charts, I should, some people should have, to talking about T-charts. I'm like, what is a T-chart? Into my phone, but it didn't tell me. So I've never taken a course in accounting, ever. But I have worked on many projects. I now get accounting, and to me, there were epiphanies along the way. So hopefully, in this couple hours that we spend together, even if you know a little bit about accounting or you know a lot about accounting, hopefully there are a few things that click that you might not have otherwise. Yeah. So that's my intro. Now I'll start with a PowerPoint presentation. The first one. Everyone here is focusing on this, but I learned something else important. Have you ever tried to learn something new and you're distracted? It's hard, right? Mm-hmm. So if you need to work on something important here today, it's okay to take a break, step out for a few minutes, do something there. But if you can, unless you're actively taking a note or something like that, try and shut the Chromebooks down, because you're going to be, I've worked here long enough. Your email's up, your messages are up, you're going to work on something that's more important or more urgent, maybe not more important, more urgent than this. So we'll take some breaks, definitely have time to work on this, but try and shut down to the extent possible and ingest for your mind. Does anyone here not take pictures when they go places so they can focus on what's around? They don't do that because everyone takes pictures.
My wife takes little pictures of it.
I know some people actively don't take pictures when they go somewhere really
scenic, because they want to take it on.
Yeah. I take pictures. I know some people don't. All right. So the only person I know that actively decided to come here today on their own was Ryan.
That was me too.
Yeah, me too.
I said that I know. It might be other people.
Yeah, Gary didn't have me.
So for anyone that either actively came here or didn't actively come, is there anything that you are expecting or hope to get out of this? I want to make sure that it's not a complete waste of time. Anyone? Better understanding of accounting.
I have a pretty decent understanding of accounting, but I figured you are the master of all this, so I want to come in and see what you have to say.
Like I remember the accounting equation, but like with SHG, like struggle to remember sometimes what should be a debit and what should be a credit. So that's really what I wanted to get a better grip on from coming here. I know I'll have more projects like that.
Debit and credit, yeah. Let's start there. Does a debit make things more or less?
Depends on what it is.
Why? Why does it?
Because the different types of accounts mean different things. So if it's an expense account, it's different than if it's an income account, and you're going to be getting it's going opposite direction in either of those defaultly. So the debits and credits are kind of reversed.
Why?
No idea why they do it.
Because accounting says so.
Yeah, so I start with that because if you heard me in the meeting yesterday, I said that if you're not able to join the beginning of these meetings, it's not worth continuing on. So one of the most difficult things for me to grasp as I start to go through this is in my own mind, why are things different? Like, why does a debit go up in accounts receivable or not go up in expenses? What's going on? Like, why is that? And I'll take two steps back. I won't answer that yet, but we'll get there pretty quickly. So let's start with even a more basic question. What is a general ledger? I can tell you one thing. It's not a diary. I got that wrong. What's a general ledger?
It's a record of all of the company's transactions.
Wrong. You know you're supposed to not say people are wrong.
Can you say nope?
I'm not good. Yeah. Nope. So what's a general ledger? Anyone else want to take a gander?
It's it's where you record the different sides of a specific transaction. So it doesn't have to be all of your transactions, but it's every, not every transaction, but some transactions are done in a general ledger because they're not specifically bills or what are the other ones? Payments, right? Because those are handled differently, but, things that are not bills and payments tend to go into a general ledger accounting where they say what account they come from and what account they go to and specifically balance each other out for every.
I don't know if I'm just confused or not, but I can't say no, because you might be right. Brain just cut out. I think you might have an aspect of that, but I think what you said earlier was right. It's not every transaction, right? If I have a new employee starts, does that hit the general ledger? It's a transaction. What about if I have a sales order? Does that transaction hit the general ledger?
No.
Tommy says no. Does everyone agree no for sales order?
I don't know.
So, an invoice, that is general ledger.
No.
No. Anyone else agree with that? So, the general ledger is a list of all the transactions that are going to affect your financial statements. So let's start there. So there's a difference between what are called posting transactions and non-posting transactions. This is probably the first concept that is important to know. Things that are non-posting transactions don't show up on financial reports. And when I say financial reports, that's what accountants, it's what their core financial reports that are the balance sheet, the income statement, cash flow statements. I'll explain what some of those are. But if it's non-posting, it might still be really important. And we look at our orders every meeting, right? Our sales orders, still important, but sales orders don't post to the general ledger. Sales orders don't have debits and credits. So that's the way to think of it. A posting transaction has debits and credits, and those debits and credits equal each other, right? So an invoice is a posting transaction. So the different kinds of transactions that you'll have are things like invoices, payments, bills from vendors, when you cut a check to a vendor or make a credit card payment, if you pay an employee. There's what are called journal entries that move things between accounts on the general ledger. So anything that's a posting transaction hits the general ledger. And that's the first thing that I want to get a handle on is the difference between a posting transaction and non-posting transactions. So posting transactions are everything that hit the general ledger. And the general ledger, by the same definition, is a list of all transactions that are posting. So the general ledger is really the very detailed view of the debits and credits for any type of accounting posting transaction. Full history of not all transactions, but all posting transactions. So you're pretty darn close. Couldn't get you 100%. So debits, credits, not there yet, but we do get posting and not posting, right? Haven't gone through what all posting transactions are yet. We'll get to there in a moment. So now the most important concept here, the graphs. Does anyone here know what a balance sheet is? Right, the most important thing to know.
List your revenue or your liabilities and assets.
It's like a combination of all that plus like every other financial thing that affects the company basically. It's like all of your assets, all of your liabilities, all of your expenses, all balanced together to show like both columns have to be equal at the end, and they have to show like the sum of all of your credits and debits have to be the same, otherwise you're not in balance.
Close. So the reason I stared at Ryan is if you've ever watched a baseball game, and if you've ever seen a play at home plate is how you score a run, right? So if you get to home plate and the guy goes and he tries to touch home plate, but he misses home plate. And then the catcher, the guy who's there with the ball, tries to tag him but doesn't tag him. What does the umpire do?
Win.
He doesn't do anything. So Ryan, you were so close. Yeah. I just kept staring at you because you had the assets, the liabilities, and equity. So what it is a balance sheet. There's assets on top, and then it has liability and equity on the bottom. So now the question that I would ask is, what's an asset? asset. Inventory. It's a type of asset.
Something of worth that you own.
Yeah, something worth. What is liability?
Something you owe.
Yeah.
And what is equity?
What's left, the difference is significant.
See, I wrote myself, I know. So I actually had this, it's things that you own that have value. This is, and, it's worth of what's there. So I'll give you an example of what this means, and sometimes words are hard to explain. Imagine that this is a block of gold. Right now I have a block of gold. Who wants a block of gold? How much were you getting for a block of gold?
As little as possible.
Yeah, so you would get a dollar. for a block
Right.
of gold, like, and this block of gold is worth $10. $10, everyone, $10 block of gold. Right? Is that a deal? Or it'll be a dollar.
I'll give it to you, but it's $10.
So you owe me a dollar. You have a block of gold. How much is that block of gold worth?
It's worth $10.
$10. So what you have in your hand is worth $10. Tommy has $10 in assets. Liability. What are your liabilities? $1. So you see, that was a financial transaction. I just gave Tommy something, and the balance sheet, the top has to match the bottom. Right? That's what balance is. Top matches bottom. So right now, what's the value of Tommy's gold business?
$9.
$9. Right? Because he could sell that thing for $10. He'd still owe me $1. So the value of his business now is $9. That's the equity. That's the worth of what he has. You buy a car. Assets worth a certain amount of money. It might be worth $15,000. You might still owe $5,000 in your car. The equity on your car is $10,000. You sell that thing for $15,000. You still owe $5,000. The worth is $10,000. Make sense? So everything that accounting is all about, I still don't get T-charts. I love the T-charts. That's true. I still don't get them. I understand why they have that T-chart. It's kind of the foundation behind this. But I started level beyond that. So now let's think credits and debits. So now every transaction is going to balance itself on the balance sheet. So that's what to think about. It all starts with the general ledger, and every transaction has to balance itself. So with, not my cheat sheet, because I don't have debits and credits off the top of my head. So what happens is an asset is increased by a debit. Right? So the idea is every transaction, and think about it, every single transaction has to, in and by itself, balance itself. So if I have an asset, if I give Tommy a pen, and then he gives me a pen back, well, that might just be an asset minus an asset. So it balances itself to an equal zero. Give him $5, give me $5 back. That balanced itself because it balanced to zero. Nothing was affected here, but this equals zero. If I give Tommy a pen, and he gives me a pen for $10, he gives me $10 cash, well, that's an asset for an asset. So that is increasing what Tommy has, which is a debit. If I increase what I have, it's a debit. But then if it gives me $5 back, that's a credit. So if I decrease an asset, it's a credit. Right? So liability and liabilities and equity, this is the opposite. But if you increase a liability, it's a credit. And if you increase equity, it's a credit. So this is essentially saying that if I have a transaction, the whole reason we have debits and credit is to make sure that things count. If I have something on the top, it has to be the opposite of what's on the bottom. So that's why liabilities are credits, because let's do the same example. I gave Tommy a pen, said you owe me $1. That's what it said at that point in time. So at that point in time, I'm actually going to go for this specific example right here. Let's forget about it being worth $10. I'm not going to give Tommy a pen for $1 if it costs $10. That wouldn't make sense. I'm going to give Tommy a pen for $1 if it's worth $1. So if I give Tommy a pen for $1, what is that going to do? Debit or credit? Which account?
It's gonna credit the asset for $1 and debit whatever form of money I'm giving in cash for $1.
You didn't give me cash. That's my idea.
All right, fine. And it's gonna put it into a liability, I guess, as a debit again.
So what happens is I gave you a pen, your assets increased.
Mine did, yeah.
Yours did. So increasing an asset is a debt. So debits and credits, what happens is your asset, your value, your pen, you got a pen. You now have something.
Mm-hmm.
That increased. You owe me a liability. So that increased my liability. What I owe, I now owe $1. So that credited my liability. So I have one transaction that increased my asset because I now own a pen, I own $1, and my liability also increased because I owe $1, so I owe a positive $1. Yeah, it's kind of backwards, but I owe $1, so it's a credit. So two things increased on the same transaction. That's why it's not plus and minus, because two things increased, the amount I owe and the amount that I have. It's not a pen. If I give you $1 and I say you owe me $1, you just got $1, you also now owe me $1. Debit and credit. So that's why different accounts are debits and credits. Just so it balances. It's the only reason things are debits and credits, to make sure the balance sheet balances. So the next most important thing to understand is every transaction must balance or it's wrong. If you ever are doing an accounting integration project and you're building an accounting system or doing anything around accounting, and you get an error that the accounts are out of balance, the logic's wrong. We made a mistake because accounting says it can't be wrong. If we send over a transaction that says, I just gave Tommy $1 or a pen, and that's the only thing I send over, well, I'm missing half of it. So that's the checks and balances. It must balance. Makes sense? Makes sense, okay. Now let's keep thinking about the balance sheet. The balance sheet describes, and think about it, the value of your company. Really describes the value of your company. Let's take this away from companies, because companies are confusing. People are not confusing. No, people are confusing. Don't tell that to anyone who has technology. So, can anyone here tell me, can you run a balance sheet over a period of time? Like, can I run the balance sheet from January 1st of this year through the current date?
Yeah.
Let me ask you a question. Let's just think.
But actually, it's not.
Let's think about your bank account balance, right? So your bank account balance. Then we're going to shout out how much they owe now. So imagine that you have $100 in your bank account today, right? So, Ryan, let's use hypothetical numbers. Sure. What's your bank account balance from January 1st through today? As of today, right? So the balance sheet is always as of a point in time. So what the balance sheet is showing you is as of today, I have $10 in my bank account, right? As of today, $10 in my bank account. As of today, I owe $1. As of today, my worth as a human being is $9 plus all of the great things that I get as you've had. Non-posting transaction. So balance sheet is as of a point in time. Again, just think about if you have a loan, that loan can change over time. How much did you owe last week? How much did you have in your account last week? It changes over time. Right? So this is as of a point in time. And you can typically run that as of today, you can run it as of last week, first of the year, but the balance sheet is always as of a point in time. Because if you were to say, how much should I have in my bank account, on Monday and Tuesday and Wednesday, I can't just add those things up. How much was I worth yesterday and today? I can't add that up. It's already adds up. Does that make sense? So now let's get into making money, losing money. So there's a whole other super important report. So the first, most important report is the balance sheet. And I say it's most important because the other financial things stem off of this concept. When you talk to business owners, oftentimes the next report that I'll tell you is more important than the balance sheet on a day-to-day basis. Profit and loss. Also called an income statement. So if you've ever heard of an income statement or a profit and loss report, it's the same thing. Does anyone know what a P&L report is?
Same thing.
Profit and loss report. So profit and loss report tells you what?
What you made and what you spent.
What you made. So there's something that's called revenue. Spelled with a U. And there's something called expenses. And then there's another little concept here that I'll get to in a bit called cost of goods sold. So there are three types of accounts that show up on a profit and loss report. Revenue, what you've made, cost of what you sold, and expenses. So temporarily, I'll skip the cost of goods sold. We'll come back to that as we get to inventory. This has to do with buying and selling inventory. Revenue. Does anyone here know anyone or themselves receive a paycheck? That is something. So that's money that you received, right? That's in your own world, that's revenue. So if I received $10 this past Friday, my paycheck, how much money did I make on Friday? $10. Let's suppose I make $10 a week.
And then it would have been $20.
Okay, $20 every other paycheck, but assume local families didn't take anything out. That's what take home pay. So $10 is what I made last Friday. Let's just say that. And then skipping the cost of goods sold expenses. Everyone here have a cell phone that you pay the bill for? $5 a week, reasonable, $4 a week. So that's an expense. Things that you pay, things that you've paid out are expenses. $5. So if I had a $5 paycheck or $10 paycheck on Friday, and then I had that $5 cell phone bill due on Friday, how much should I make on Friday?
$5.
That's good. I'm in the green. $5. So the profit and loss report is fairly simple, right? You figure out how much you made, figure out how much you spent, and this is called the profit. Make sense so far? Can you run a profit and loss report over time?
Yeah.
Sure. Everyone said yes to the balance sheet.
Yeah, no, I was wrong. I said immediately, wait, no, you can't. You can run as of these.
So, yeah, so if you look at, say, how much you made over the past year, you have $10 a week, over a year, that's 52 weeks, $520 over a year. You paid $5 a week, that's half of that. So you can run it over time because that is editing. Take all the money that's come in, and then you take all the money that's gone out, and that's your profit loss. Does that make sense? So, the question here is, I take $5 profit in this example. I don't know where this ends up on the balance sheet, it does it all. Where are revenue and expense accounts on the balance sheet?
Assets. Well, assets and liabilities. Expenses are a liability. Yeah, the profit would probably show up under your like cash account or some kind of a bank account statement on your under your assets.
Thoroughly confused everyone, which is a good thing, because we wouldn't be here if I didn't attempt to confuse you. So when you look at a chart of accounts, which is how you describe your different accounts, you have asset accounts, you have liability accounts, and you have equity accounts. That's the name of the type of account. So you might have what's called an inventory asset account. You might have a long-term liability or a short-term liability. These are types of accounts. If you ever go to QuickBooks, you see types of accounts. A type of account can be an asset, liability, equity type accounts. Those are called balance sheet type accounts. You have revenue, cost of goods sold, and expense accounts. Those are called P&L accounts. So while that transaction that I just described, where you got paid, would impact revenue and a bank account, and the expense would impact expenses and a bank account, or expenses and a liability, that transaction would have two parts to it. Revenue and expense accounts are not directly on the balance sheet. But that gets confusing, right? Because now, I'm going to run through again my very simple example of I just run through this example. Ready? Let's start off a new business. Who wants to name the business? Someone creative or not creative. I'm going to do it very quickly. Come on.
Let's go with John's Accounting Service.
Wait, what did you say? Podify? It's like Spotify for some marijuana. Or let's go with pop. They sell pop. Sure. So, Podify. So let's imagine that you decided to open this business with all the money in your bank account. So right now, Ryan, you're a human being, but you're going to create a company called Podify. And you're going to take all the money in your bank account, it's $10 from last discussion, and put that into Podify. So there is a transaction on day one, the creation of the company. What does that transaction look like?
It's going to be,
Yep, I have $10.
it's a debit.
Debit to my bank account. A bank account is cash. Cash is something that you have that's worth money. Cash money. It's good.
And then there'll be like a liability credit to like investor.
Now, what equity?
For equity. Yeah.
Because that's the worth of the company now. So Ryan doesn't owe himself anything.
Unless it was wood pens.
Yeah, so he put owners, it could be.
It could.
If you borrow that, he didn't borrow from himself. That's going into the company. So it put $10, so it's a $10 credit into the company. Everyone with me here so far? So now, let's do it. Ryan is going to get his first bill. He's going to buy a business card, and say 100 business cards, and you're going to pay $5 for this business card. You're going to pay with an IOU. All right? We're doing it for the cash you're a business, pay on terms, right? You know, pay on terms. IOU equals pay on terms. So, can someone tell me what that account is?
You now have $5 worth of business cards, and you owe $5.
Well, so you have $5 worth of business cards, but I'm gonna start off with,
An asset, $5,000. Well, it's not really, it's a,
it's not an asset,
It's not
right?
an
Think of it, your business card, are you gonna sell them to anyone else for
No.
$5?
yeah, they're non,
Yeah, so that's not an asset. But you owe $5, let's start with that.
Correct.
Credit the liability. So we credit it $5. Then what's the other $5?
it's an expense, it's like
An
a,
expense, right?
operating expense.
So that's a P&L type account, right? An expense. So did my balance sheet just get out of balance somehow? Right? So I have my balance sheet account, which is my liability, and then my expense, which is $5. So there's a little trick in here. The net total, your total profit as of the time that you run your balance sheet, it's called net income. So remember how we had $10 minus $5 equal 5? Well, here right now, the only transaction I have in my whole P&L report is a loss of $5. So I have a loss of $5. Net income is a line under equity. So this reduced my equity, so it's going to debit my equity account. Debit $5. We're just going to reduce that. So the way that the balance sheet and the profit and loss are related to each other is through that. So you have your balance sheet accounts here, and you have your profit and loss accounts, and your net income is essentially the profit that you've made as of the time that you run this, and that is a calculated field that goes into your equity to make sure everything balances. So there is only the balance sheet and the expense accounts so that everything is debited or credited. Does that make sense? So I just got paid. I got a paycheck for $100. Direct deposit, bang, right into my bank account. What's that transaction look like? Revenue first, right? Revenue. And what should I say? I did $100 for a lot of money, right? And then what else? So this is going to go up. So it's going to increase this by 100. It's going to credit it. And what else? Just got $100.
It's gonna, yeah, it's,
Money. So $100. So now I have $100 in assets, $110 in assets, $110 in assets because I sold the $10 that I started the company with. I have $5 in what I owe. I have now I have $10 that I started with, $100 here, and then I debited my $5. But I missed something here.
2.5.
You don't have the $10 anywhere.
$10.
It's 110 minus 5.
Yeah. total, I have $105 in my bank account now. As of now, it's $105.
But you still have 110, right? Because you haven't paid the bill yet?
Yeah, I still owe,
Don't you have $110 in your bank account?
oh yeah, gotcha. $110. I owe $5. I have $10 in the equity that I started with. That's credit. I have $100 in credit from this $100 transaction. I owe $5 and I lost $5 in my net income on that, so these cancel each other out. So my credits are $110, my debits are $110. Everything equals. Again, if they don't equal, something's wrong. We won't be here for 20 minutes, is that right?
Really?
I saw you about it.
I was saying,
Let's take a little break. Let's take a break, stand up, 5 minutes. Let's start at 10 there. It's a lot.
We missed one.
Equity is off of the $10. Yep. That is what I put into the. And then I owe $5. Yeah.
But these two don't have the value. Because they're two separate ones.
Yeah, we just, yeah,
They're disconnected through having.
so this has the balance of this. So this one right here, this 95, is how this balances. If I didn't take this 95 here, then it wouldn't balance. So the revenue and expense definitely doesn't balance. Okay. I should have not profit consider non-profit.
Right.
It's just funny you mentioned that nonprofit thing, because I remember this is all different based on what type of corporation you are. I don't know if we're talking about any of that stuff, but
We're just gonna talk about for profit.
how that, like, yeah, or for-profit. That's the only reason that local thing.
I'm not sure this is different. For nonprofits. And everything we're talking about here is.
I think the taxes are one thing that really gets weird for nonprofit.
I remember like there's sole proprietorship and S corporation, and like they move around everything with the accounting equation based on what kind you are.
Yeah. But, yeah, but I still think that.
The account, yeah, that helps.
The accounting concepts are the same thing. Who went for the Scriven certification? Did they teach this stuff?
No, not at all. The Scriven certification for accounting was all about Scriven. Like, that's all it was about. It wasn't about anything with accounting.
It would have helped to have.
I don't think so, honestly.
This before the strip.
Well, it depends.
I don't think it would have helped too much, honestly. Like, what we were looking at for Scriven was really just like, where are these things located? What does that icon mean? What does this thing do? And so it really wasn't relying on you knowing anything about accounting as much as it was. It could have
named anything.
It could have, yeah, it could have been anything. Like, they were teaching you how to use the system, and whether you understood what you were doing or not was irrelevant, really. So. I hated that module, but not because of accounting, but because it was just some of the questions were labeled really weird.
You wanna write it up there?
Sure.
And when you sell them, we'll just
Sure.
There's a neat little thing on accountability. Now that you've taken this class and you know the debit and credit have to equal each other, if you're involved in any project, it's your sole responsibility to figure out why and resolve.
That was the case even if we didn't.
Very clear.
That part's usually easy. Normally, just like something is labeled a debit and not instead of a credit.
Yeah.
There are debits, right? We're just having that. So the trick here.
The hard part is knowing which one's right.
Yes, exactly.
That's the
You
hard
just
part.
assume that everything's right, you fill in the gap, you
Yeah.
could still be wrong.
I think the hardest part is like when you're trying to build something off of something else and you realize that the original one was built in the first place. That's like, you've been wrong forever. Now we're right. I'm sorry to tell you, like,
But there's like, then
it happens
Hard to
way more
explain.
often than you think.
It's hard to explain that, like, hey, Mr. Customer, you do accounting wrong.
Yeah.
By the way.
Oh, and by the way, it's been wrong for the last 20 years too. So I'm just letting you know. It happens very often. But usually it takes a long time for you to get to that conclusion because you don't expect the original system to be wrong. So. Painting through like hundreds of lines of data, just trying because you have two separate numbers that are completely different. So, trying to find out that one transaction is different when it's actually three that are.
I worked with a customer, and they were running reconciling their system against their financial system. They were, I think, like $2.91 off or something, right? Well, it turned out that it was about 4,000 transactions. In aggregate, at $2.91, it never got over to their financial system. So,
Yeah,
small dollar amounts don't always.
it doesn't mean anything. Yeah.
Just create a liability for the amount, that's not without and worry about it later.
As long as you know what caused it.
Yeah, you just put a note.
Yeah, but that's the hard part is figuring out why it happened. So that 10 years later.
4,000 transactions that come to $2, that means you're gonna spend a long time looking through.
And you won't ever find it if you're just looking through the one system.
Just make an account called allowable tolerance. Reasonable tolerance.
So, just throw the abstract.
Yeah.
Mr. Accountant. I've seen customers do worse.
Yeah.
Had a customer, they built their own, jumped into accounts receivable next, and they built their own accounting system. And then the person who built it left. So they called us up, right 6 months after this, issue all about to mention, came to light, which is they had two different accounts receivable. Accounts receivable is money that's below you. And, they didn't know about one of them. It was $500,000 in that account.
So the guy that left just took that with them.
Yeah, it's,
That was money that was owed to them, it wasn't actual cash, but they never followed up and collected it, and it was 10 years old. So they just, it was a large enough business that it didn't cripple them. $500,000 that they just never collected because they didn't know there was a button to hit other accounts receivable.
surprising that
Why
none
would
of
they
those.
even have two accounts receivable?
They had no, they had two different parts. of
Visions,
this.
yeah, like,
All right.
it's convoluted when you get big systems and small accounting systems.
All right, get started. So as a reminder, it's hard to acquire skills while not focused. I took a really boring class one time again when I was in college. And it's good to take really boring classes sometimes if you have instructors that know that they're really boring. Because they taught me all kinds of tricks. And the rest of it, there's probably 5 of us in the class on how to keep yourself awake from really boring classes. So, stand up, stretch, actually get your blood moving. Whatever, if you just sit there and you don't move, you're going to sleep. So don't sleep. Let's stay engaged in this topic of account. So Ryan asked a very important question. Do revenue and expense accounts have debits and credits? I talked here about assets, liabilities, and equity having debits and credits. If I have an account where I got $100 in my paycheck, that's going to debit my bank account. Revenue. Does that have a debit or credit? The answer is yes.
Yes.
It does.
No.
It's actual revenue. So the asset was debited. The revenue was credited. So I talked here about how the asset, if you increase it, it debits it, and the liability and equity, if you increase it, credits it. And if you remember, the revenue and expense are really underneath equity or a type of equity account. So if I have revenue, that's increasing my equity. So even though it's a revenue account, it's going to be credited. That's why having these accounts, it gets a little confusing because some things are credited, some things are debited, and they're not all on the balance sheet. So that's kind of the next layer is, okay, I can have a transaction that is an asset and revenue, debits asset, credits revenue. And the reason it's crediting revenue is because that's an equity type account, or it's going under equity, it's not an equity type account because it's net income. So it credits that. And expense decreases my equity, which is why it debits equity. It's really negative equity when I look at it. So if you look in your general ledger and you see that paycheck, it would be $100 debit and revenue $100 credit. So P&L accounts do have debits and credits. Every account has a debit and credit. And the reason that revenue is a credit and expense is a debit is because the debit decreases to my net income, which is under equity. So it's debits and credits are just a way to make sure everything stays in balance. My balance sheet stays in balance. That's what it's all about, keeping the balance sheet in balance. All right. Now let's go through some different kinds of transactions, right? Let's talk about accounts receivable. So I started out when I said how I got this completely wrong in my interview. But I've already given several clues. You probably worked here long enough to know what accounts receivable is. Who wants to take a shot? What is accounts receivable?
Money owed you.
Yeah.
Money owed to you. Yep.
That hasn't yet been received.
No.
Yeah.
You owe me $10, give me $10. I'd love it if you still owe me $10.
Right.
Borrow more money from you.
Right.
All right. So accounts receivable is money owed to you. Is accounts receivable, where does that fall in my list of assets? An asset.
Mm-hmm.
Accounts receivable. Money that's owed to me. I'm going to make a statement here, and I'm going to come back to it. That is correct in accrual-based accounting.
Mm-hmm.
Accrual-based accounting. So there's cash-based accounting. That's what I'll get to later. And there's accrual-based accounting. Accrual-based accounting means that as soon as I get an IOU, that has value. soon as I send an invoice to a customer, that has value. They haven't paid me yet, but because I sent them the invoice, that invoice in and by itself has value. For most businesses, that's how they run, our accrual-based accounting. Many businesses that are of a certain size are required to work in accrual-based accounting. Some smaller businesses and some businesses can run on cash-based accounting. And how do they decide what to run on? Whatever's fair. They can pay the least tax. So what, I'll get to some things related to cash-based accounting later on. But for the time being, accounts receivable is money that's owed to you, and that's an asset.
And you can't mix and match. You have to do one or the other. You can't do like, for tax purposes, be cash and for the rest of the year be accrual based.
Yeah, correct. You can run cash basis reports, even though you're not reporting that to tax agencies. You're going to say something?
I wasn't at a real world, not specifically related to it, but have you had clients that are cash-based accounting?
Yes.
Okay.
Not many, but there are. So, accounts receivable, money owed to you. Here at Miles Technologies, when does something hit accounts receivable?
When we invoice it, or so they approve it, yeah. What's silly when we invoice it?
Yeah, so we invoice it. So again, we're going to come back to posting and non-posting transaction. If the customer hits approve on a sales order, is that a posting transaction? If the customer hits approve on the sales order and it's invoiced 100% upon clicking the button, is that a posting transaction? The invoice, yes.
The invoice.
Yep. If the customer hits approve and they get an invoice and they pay the invoice immediately, is that a posting transaction?
Yes.
Yes. Are there several posting
Yes.
transactions? There's an invoice and a payment. There are different types of posting transactions. So, get rid of the right side here. So we talked about an invoice. What is another type of accounts receivable type transaction? What? Customer pays. Yeah. What else?
Credit note.
Credit memos. I'm going to make an assumption everyone here knows what a credit memo is, but I'll tell you anyway. A credit memo, so if you invoice a customer $100, but then because of the customer service we said only require them to pay $10, you're giving them a credit memo of $10. When we credit and we give customers credits, that's really what it's saying. Even though we invoiced you a certain amount, we're going to write it off. Is another thing that credit memos are called write-offs. What else? What other types of accounts receivable accounts are there? Yeah. So I'll answer Ronnie's comment there, and then he self-corrected himself into a wrong answer. Thanks, self. Sales order. Is a sales order a posting transaction? No. Sales order is when a customer agrees to buy something from you, but you haven't yet invoiced it, so it doesn't count. It doesn't count on your financial book until you send them the invoice. Then it counts. A purchase order is a non-posting transaction, so it's not a payable account.
It's the bill.
Because the bill, when you get the bill, is when you owe it. So you could agree to buy something, but if you never get a bill for it, then great. But it's not posted. Any other accounts receivable transactions? I can't think of any. There are probably people with different things that people would call it. But an invoice is what you give to a customer and you say, okay, you have to pay me $100. They don't know what payment terms are.
How long you have before you have to pay it.
So invoices typically have payment terms, which is essentially defining what the due date is. You have payment terms, which could be Net 10. Net 10 means you have to pay me what?
And
Net 30? Net 10/2.
Get 2% for paying,
within,
2% credited for paying within 10 days.
Yeah, so sometimes Bill can give payment terms different amounts, but sometimes you'll see things like that where if you pay within 10 days, you'll get, or a certain number of days, you can get a 2% discount or a certain discount off of your invoice, but then if you pay by the due date, there's not a discount.
finance charges is another one I forgot.
What's that?
Finance charges should be another AR type, right?
Finance charges are typically not AR.
Yeah.
Because finance charges result in an invoice.
Okay.
So what happens is, okay, I received the finance charge, I now get an invoice for that finance charge, or it's added to an invoice as a line. So customer payment is a type of AR transaction. So if I invoice customer $100, the customer pays $100, and I credit $0, that's two different transactions. Right?
Mhm.
Makes sense. Okay. Simple stuff. So now let's go through the financials for this. I just gave a customer an invoice for $100. What does it do on what does it credit and what does it debit? Asset. You debit an asset for $100. So I now have $100 because the customer said he's going to pay me. I have an invoice, correct. What else? Revenue. Yep. So revenue would be credited. No, we're debits and credits. Isn't that one? Without a cheat sheet. Yeah, that's right. Debit and credit. Now, customer pays me $100. What does that do? It's tricky, right?
It's going to credit your AR off, but then debit like a bank account.
Credit that. That's right. And then it's going to debit plus $100. So it doesn't touch anything else down here. When the customer pays me, it wasn't revenue, it wasn't an expense, it wasn't liability, it wasn't equity. Customer paid me. I already hit the revenue. I already got that $100. So a payment doesn't hit your profit and loss report in accrual-based accounting, which is what we're talking about here. The payment simply eliminates the accounts receivable and increases my bank account.
That's why it's not posting.
Payment is a posting account.
So the original one was not posting.
The invoice was posting. And now, that's good question. Now, I'll write it down. So my invoice was posting. So my invoice, and this is, and then payment. There are going to be multiple accounts involved. I'm going to have an AR account. I'm going to have a revenue account. I'm going to have a bank account. So the invoice is going to increase my accounts receivable through a debit.
Mm-hmm.
The invoice is going to increase my revenue through a credit. That's a posting transaction. So this one transaction really is two transactions on the general ledger. It's this and this. But it's one transaction. It's the general ledger, so it's posted. By payment, now customer doesn't owe me $100 anymore. So it's going to credit my accounts receivable, and it's going to increase my bank account. So this is the posting transaction. Bank account is an asset. Bank account is an asset. It's something that I have that has value. Money. You know, money has a lot of it. Depending on the country. Some countries, they give it, $1,000 bill and it's worth 50 cents. That's frustrating. So invoice, payment, both posting transactions. Chart of accounts. Does anyone want to now take a stab at what the chart of accounts is?
The list of all these, list of all the different accounts.
So for the first time, we're in the first time that I've introduced the concept that I can have more than one type of account. I can have more than one type of asset account. I can have a bank account,
Cash account.
and that is an asset. I could have AR, which is an asset. I can have inventory, we talked about, as a type of asset. And each one of these, I can have different accounts. Like each credit card that I owe money on is a separate liability account. Revenue. You can have, we could have separate revenue accounts for business software solutions and IT services and marketing to separate where our revenue is coming from. So each one of these, you can even have multiple bank accounts. So when you look in something like Scriven, what you'll see is when they define types of accounts, and QuickBooks does the same thing, not everything that's an asset is called an asset account. Some things are called a bank account. Some things are called accounts receivable account. Some things are just called short-term or other asset account. Some things are called inventory asset. Any of those things is a type of asset account that shows up under assets. Same thing with liability. I have multiple kinds of liability accounts. Same thing under equity. I have different types of accounts. So my chart of accounts is all of the different ways that I want to see my finances broken out. That's what the chart of accounts is. So make sense so far?
Mm-hmm.
So now what's unique about accounts receivable accounts is that unlike most other types of accounts that you talk about, it's important that I know how much money is owed to me, right? That's important. So let's suppose we didn't get that payment, check balance. Let's suppose I never got the payment. So we get an invoice for $100. Now let's suppose I get another invoice for $200. I won't ask you what the debits and credits are because it would be too easy. You just look it up, see it. So I have another $200 in revenue and another $200 in accounts receivable. What's my accounts receivable?
300.
Who should I ask for $300 from?
How much are an invoice? Yeah.
So accounts receivable and accounts payable are separated out as different kinds of transactions because not only do I care about how much money it is, but these should always be tied to a customer. So there are ways in QuickBooks and there are ways in financial systems where you can have AR transactions that don't link to a customer, but it's a bad idea. Shouldn't do it. It's not a best practice. Every one of these should tie to a customer. So this invoice is for customer A. So I want to know who the invoice is for, and this one is for customer B, for $200. So what's important in accounts receivable is not only does it hit the financial account, but it links out to a specific customer account. So now, if you ever run a financial report on accounts receivable, and actually, very well financial. Let's say again the invoice. Let's suppose customer $100, the accounts receivable customer A. Now let's assume I receive that payment from customer B for this invoice. Is that possible? Yeah, financial systems don't allow that. So sometimes you have to get a little bit tricky. But let's say here that I now receive the payment for the invoice. Right? We already know what that does. It's going to decrease my accounts receivable, and it's going to increase my bank account. Now, payment. This invoice, how much is owed on this invoice?
It should be $0 on the invoice, as long as that's the payment that we made to it. But you have to apply the payment to the invoice.
There's that applying process, which is what I'm doing. So customer A had an invoice for $100, and the customer also had a payment for $100. The amount of this invoice that's still open is $100 until I say in my accounting system that this payment should be applied to that invoice. So there's a process of applying a payment to an invoice that's very important, because until you apply this, the financial system thinks that this invoice is open, meaning that it's not yet paid. So if I run accounts receivable reports, it will show that I might have an invoice that's months and months old that hasn't been paid.
And it's generating finance charges because
Might be generating finance charges, right, in some cases, because it hasn't been paid. Either the customer made a payment of $100, which is also now open and could be applied to anything. So there is a process of applying payments that's very important, because whenever you have invoices and payments and credit memos, you need to say that it's, that it's closing it or it's canceling something else. Now, what is the financial transaction that occurs when you apply a payment to an invoice?
their customer's account, like you're changing the value that they owe, basically.
Does it hit the general ledger?
No, it's a non-postal.
Does everyone agree with that? I don't hear screams of yes or screams of no. I mean, you're right. Well, I already received it. I'm saying, so here.
Things be applying.
So I could have sent this invoice on 1/1. I could have received this payment on 5/1, and then today, on 9/18, I can do the applying, right? So on 9/18, is there any transaction?
Yeah. Well, there's a transaction percentage.
Yeah, there's nothing hits a general ledger at that time. So that's the applying process is very important, because if you don't apply transactions, it will cause reports to be off, accounts receivable reports that show open transactions. It could generate finance charges if your system is generating finance charges for late transactions, but that applying process isn't hitting the general ledger. All right. So there's a neat other concept I mentioned while a few of you are still out, that now that you've sat in this session and learned this skill, everyone now knows that debits and credits must equal out. If you're involved in a system and it doesn't, well, that's your responsibility to make sure it's solved. So I've been involved in a number of projects where we've talked to customers and we say, okay, we're going to do an integration with your accounting system. And then what we do is we say, okay, we're just going to do accounts receivable. And again, I've seen this more than once. We say, okay, we'll generate invoices and payments. And the customer says, yes, that's great, good. You're going to integrate my accounting system. And then we build the system, we build the integration. We get through, we start testing it. And what do you think happens?
No, the payments get closed, or the invoices get closed.
One, the invoices may not get closed. Definitely seen that one. What else?
They're not like go to the customer accounts at all, I think. Okay.
So then, normally we catch that one, of course. We could theoretically set. What I have seen happen more than once is during our beta testing, during our adoption, during some part of the process, hopefully before we go live, hopefully before we design it, the customer now gets a negative invoice. Well, what's a negative invoice? It's a credit. I mean, essentially, an invoice is saying that the customer owes you money. A negative invoice really means you're giving the customer a credit so they can use it to apply towards an invoice. So we forget that if we're doing accounts receivable integration, it's not just invoices and payments, it's also credits. Make sense? So you're doing an AR integration, and you're working with QuickBooks, and you're using an IIF type approach for integrating invoices and payments. There's a neat thing that's really important to know. IIF imports don't allow you to apply payments to invoices. So the customer still must manually take that action within QuickBooks. If you do that text file, doesn't allow it. Striven, I believe, does. So that's one of the differences.
You can do it with the other, like the API method through QuickBooks too, though.
Yeah, through the API method you can. So there are ways to do it. In the IIF, the text file import, it doesn't apply it to limitation of the IIF. Sorry, method of QuickBooks invoice. All right. So we're on accounts receivable. Does anyone know what a cash receipt is? Cash sale. Sales receipt. What is that?
So it's just a sales transaction that they pay for cash, and so it's still an accounting transaction, but it doesn't hit AR because there's no, that median step isn't needed, so it's just gonna go directly to either the cash account or the bank account, wherever you're depositing the cash to.
And invoice and the payment are non-signed at the same time.
Right.
Trouble. Eliminate this. So in many accounting systems, we talked about you can generate an invoice, and that's a type of sales transaction. And you can have a payment, that's a type of hosting sales transaction. Sales receipt, sometimes it's called a cash receipt, the sales receipt, is essentially one transaction where the customer, it's typically used where the customer makes a payment at the time of the sale. So if you've ever gone in, has anyone here ever gone into Wawa? And if you pay with cash, or you pay at the time, it doesn't need to be cash. If you pay at the time, the payment and the invoice are really at the same exact time. So why create two transactions? You could theoretically create an invoice and a payment, and then immediately apply that. Or you could do sales receipt, and there's no AR because this balances out. So it's just going to hit revenue in my bank account. Right.
And then typically, like, for I've seen most of the time, those will be done for a batch. Like instead of just doing per transaction, they would be for all the transactions that happen on a given day or something.
And so, and I'll take that the next step. So it really depends. Sometimes you'll have the individual transactions coming through. Again, if you're working Wawa and they're worried about your financial systems, do you really need every single line showing up in your financial system? No, not as long as you can get back to it in your point of sale system, which is where you're swiping your cards or giving your money. So normally it will be grouped or batched. So that's, if you do the sales receipt, that's what it is. Now, why would a customer choose to use a sales receipt instead of payments invoices? Simply eliminate the number of transactions that are coming over when they put it into their financial system. So let's suppose you have a customer and you require some of your customers to pay at the time of service, cash on delivery, COD. And other customers, you give them payment terms. Would it be better to use invoices and payments or sales receipts?
So I'm going to go
How
forward.
many you have that you are invoicing first?
So most of the time, you could, again, financially speaking, you could do it either way, right? You could use invoices for customers that are on terms, and then sales receipts for the customers that pay on delivery. Most of the time, though, you'll see that you follow the invoices and the payments. If you're providing terms to any of your customers, it just provides consistency, right? You want to see any of your invoices, they're all there. If For the customers that have to pay upon service, you just immediately apply the payment. So normally customers will either use one or the other approach to this. Most customers that we deal with typically have invoices and payments, but there are some that, that do use sales receipts. So it's worth noting what that is. So everyone gets accounts receivable, sales transactions, debits, credits. We did that. Allocating the financial statements. A quote. Where does that hit the general ledger?
Nowhere.
No, right? The order doesn't hit it. A quote doesn't hit it. I can go into QuickBooks and I can create a quote. It's an accounting system. I can create a quote, but it doesn't hit the general ledger. I can create a sales order. It doesn't hit the general ledger. I can create invoice, and it does hit the general ledger. Things that are not financial still are important. We talked about sales orders. If I have a sales order, and the sales order is $200, and I have invoiced $100 of that, 50% up front, 50% at the end. That $100 that hasn't been invoiced, how do I know about that? Or it hasn't been invoiced. It hasn't been invoiced. You don't know about it.
It's on the order. So the system knows what the order is, even though it doesn't account for it that way.
So what happens is I will have reports on my sales orders. And sales orders can be open or sales orders can be closed. They can be fully invoiced, is what will be described. So even though it's not hitting the general ledger, it's still very important to think about sales orders as important as financial transactions, because from a customer perspective, sales order, if it was $200 and they invoiced $100, then somewhere they need a report to say, I still need to invoice $100 from this order that's been approved. I might have given the customer goods or services, and I still need to invoice this. So we need to know what is remaining to be invoiced. So why is this important? We're going to talk more next time about migrations of systems. But if we do a migration and we start over and we just worry about the general ledger, we just worry about the financials, and we don't bring over the non-posting transactions, this $100 disappears and we never get paid. Right? So non-posting transactions are important. They're very important. Just because they don't hit the general ledger doesn't mean they're not going to equal money. Money is important to our customers. So keep that in mind. Focusing a lot on the general ledger posting transactions, but these non-posting transactions are just. What's the difference between accounts payable and accounts receivable? What's accounts payable?
It's the stuff you owe.
Stuff you owe. So really, really simple concept once you get it. Everything that we just talked about, it's accounts payable, but the other way. I mean, it's what accounts payable. If you owe, again, money you owe, it ends up in the liability account. Then it will come out of your bank account or come out of an asset account. But it truly is the exact opposite. So I'll talk about some experiences I've had working with developers and people that I work on building out. Imagine that you're building out an AR model for a system. So you get all the requirements. Okay, I need to have sales orders, and then I need to know how much has been invoiced from those sales orders. And then once I have the sales orders, I need to receive payments for those orders. Maybe there's a credit that happens, and I fill all the requirements, right? So now I say, okay, I also want to build an AP model. And we build it an entirely different way. Well, that doesn't make any sense. And it's because if you think of them as two completely different things, you're going to build them two completely different ways. So if sales orders, what's the opposite of a sales order?
Bill.
Purchase order.
Purchase order.
Yep.
Sorry, yeah.
Yeah. If you have sales orders and you have purchase orders. Purchase orders are non-posting transactions. You have invoices. That's money that a customer is going to pay you. In QuickBooks and Striven, you have bills. That's the opposite of an invoice. In some systems, they call bills AP invoices. You literally call them AR invoices and AP invoices. That's what they're called. The opposite of a credit. Bill credit. Credit memo. The opposite of a bill credit. Opposite of a credit memo is a bill credit. Everything is just reversed. Simple, right? Now, it's time to confuse me. I'm not confuse you. All right. I catch you. You have a business, right? You have a business. Two different businesses. You're going to sell him a pen. Marker.
Oh, man.
Right?
All right.
You just
Great.
gave it to him.
So you're going to sell him that. So you're going to tell him that pen's going to cost $10.
Yeah, you could invoice it now, it's not a.
It's not invoice. You're going to tell him it costs $10. You want to buy a pen for $10?
I let you try it out.
It was a demo.
All right. So he likes the pen. He tried it out. He didn't like it at first, but let's say he tried it. All right. So he tried it out. He's going to buy the pen for $10. Two different companies. Same transaction, right? What transaction just happened when he agreed to buy the pen? No.
Sales.
Sales order.
Sales order. Not posted. He agreed, he signed the terms and conditions. Yes, I'll buy this pen for $10. You then create the sales order. You just agreed to buy a pen. What transaction is that?
The purchase.
Purchase order. Yep. So, again, exact opposite. Sales order, purchase order. Right? So now, you're going to give him an invoice for $10.
When you sit here, I'm giving you an invoice.
Yep. So you just created an invoice, right? This one piece of paper is an invoice.
It's now a bill.
So he printed this out, scanned it, saved it as a PDF, then emailed it to him where it got printed out and put on a desk. That's how our customers do it. It's not us. So in your financial system, what transaction just happened?
The invoice.
Yeah, the invoice. So you have an invoice, an AR transaction, hits accounts receivable for $10, and hits your revenue for $10. You didn't print this out. You just received this. Why do I bring this up? So normally in systems that we build, your AR generates an invoice. It generates the invoice number, 12345. You then got this invoice. Is this an invoice? It says invoice on the top. It says invoice. His invoice is your bill for $10. So you put the bill in, and now that purchase order, you say this bill, close this purchase order because I got the bill. So that purchase order, you got the bill, so you don't need to worry about receiving that bill later. It's now an accounts payable transaction, right? Your system isn't automatically generating a bill number. Do you know why? Because it says 1, 2, 3, 4 on the top. That's why if you notice in accounting systems, the systems where we build that have accounts payable and accounts receivable, normally the accounts payable, you enter the reference number in, but your system still probably has an ID behind the scenes, but you enter the reference number because your system didn't generate it. It now generates the accounts payable transaction. It's accounts payable, which is a liability, and it's an expense because you're not going to sell that pen, you're just going to use it. It's revenue and hits your accounts receivable. Now you pay him, you know what happens, you pay him, that comes out of your bank account, you're paying him in cash, and also then gets rid of the IOU, gets rid of the accounts payable. Then hits your bank account and eliminates the accounts receivable. Two businesses, two systems, two transactions, but it's the same thing. So again, a lot of times we forget the fact that the same transaction just looks different depending on which side of the room you're on. And then if you're in here, I think you're just like referees from the Make sense? Seems simple to me, now that I think about it. All right. Go ahead.
I don't know.
Just excited?
I'm excited. Yeah. What's next?
Sales tax.
Oh.
Sales tax, how are the- what's the sales tax in New Jersey? 6.675. That's kind of.
Only New Jersey would make it that.
Yep. 6.675. What's the sales tax in Pennsylvania?
Eight?
That's Philly, right? We did all these transactions in Delaware.
Yeah, right.
Yeah.
Philadelphia, they had another 10%. That's what. Plus 2%. So then, Philadelphia group tax, 8%. All right. Now I just made life a lot more complicated, right? Because this marker that we just bought, it was $10. How much does it really cost? In Philadelphia. Actually, Pennsylvania. Let's say you're in Wyoming. You went for Wyoming. I'm thinking for once you make how you make it. So how much is it in Wyoming? The pen that you just bought for $10. $10.60, right? Now, this, I just made life more complicated. Decimals. Fortunately, calculators and computers can't. Yeah. The one that are going to put that on my phones. All right. So that invoice, it hits what accounts now? Accounts receivable. How much? $10.60.
No, it's $10.
$10 or $10.60. Oh, we have to vote now. So we're saying different math. Who here believes accounts receivable should be $10? Who here believes it should be $10.60? Who here is abstaining until they know what the correct answer is? Still.
I think it's still, they're both accounts receivable. But it would be like a tax.
Apply it to your tax account.
So that is correct. The accounts receivable, the amount that Jack owes you is $10.60.
But wouldn't we normally break it out into two different accounts, like an accounts receivable and like a?
Now, the accounts receivable is the amount owed.
No, it's just the amount of, you do that when you apply it.
Maybe it's yeah.
Okay, let's keep going now. Now, how much is the revenue?
$10.
$10. So I'm good now, right?
No.
It doesn't go. Although, it seems. So now, invoice $10, revenue for invoice is $10.60, AR is $10.60, revenue is $10. Where's the other 60 cents go? Sales tax. Sales tax. What type of account is sales tax?
Liability.
Why?
Because you owe it to the government.
Because he's going to give you the 60 cents. And then it's your job to not spend that 60 cents, or you won't be able to pay the government the 60 cents.
Or if you're cash paying, you can hide it all.
Yeah, then you have to pay for the ATM machine right next to your building. The charge is $3 for each person. You can't get more than $20 out. Liability. The sales tax is a type of liability account. And the type of liability account is going to then have like 60 cents. So my AR is an asset that's going to be debited. My revenue is going to be credited because it's increasing that. And my liability is going to be 60 cents. That's going to be credited. So my total credits are $10.60. My total debits are $10.60. Equal. Makes sense. Sales tax is easy now, right? Well, okay. Let's now do Philadelphia. Let's suppose I bought the pen in Philadelphia. It's not soda, so we don't need to worry about that. But let's suppose I bought it in Philadelphia. Now how much is it? $10.80. easy questions, right? So if I look at my general ledger, how many lines are in my general ledger? I look at the details, all the credits and debits.
Right now or at the end?
Right now, as in just this one invoice that haven't been paid. I have one line, I'll start with AR, that is $10.80. That's one line in my general ledger. What's the next line in my general ledger? PA sales tax,
Of 6%.
60 cents.
Mhm.
What's the next one?
Philadelphia.
Philadelphia sales tax of 20%. 20 cents, sorry, 20 cents. And then I have revenue of $10. So you can see the reason sales tax is important is you need to know not only that it was 80 cents sales tax, but you need to know it's a liability. So who's getting the money? Because at the end of the quarter, when I have to pay my sales tax, I need to know that 6% of that, this 60 cents is going to have to get paid to PA. This 2% is going to have to get paid to Philadelphia. Certain transactions are going to have to get paid to New Jersey. So sales tax, you need to know what the agency is that's getting the sales tax. So in accounting systems, if a company has sales tax, you're going to set up what are called sales tax agencies. In the case that we just talked about for New Jersey and Pennsylvania, you have New Jersey, you have PA, and you have Philadelphia. So you're going to set up 3 different sales tax agencies. Then what you can do is you can create a sales tax group that says that I have Philadelphia is a group, and that consists of PA and Philadelphia, and it just adds them together. And then every transaction gets allocated to that group. It does the math automatically. Still creates the general ledger accounts, but it just makes it so that you can combine. Some states, New York State, has many agencies. So you need to set up a whole lot of accounts for things like New York, and then California has many. And then for some systems, for some customers, if they need to pay sales tax in many different places, there are systems, I think Avalara is an example of one, that automatically is pulling the sales tax rates for each place based on where it is, because sales tax rates change too, right? Like we did this weird thing in New Jersey that we changed the sales tax rate over a period of multiple years, and it corresponded with increasing gas tax prices. So there are some tools that can get sales tax rates from all municipalities. Normally, we don't have to worry about that because people only typically have to pay sales tax in certain jurisdictions where they do business, where they have locations. But there are some weird rules that I won't get into here around that.
There's also some flat rate taxes, like I know Franklin has a couple of them that they have to pay for different things.
Yeah, so there are all kinds of unique situations with sales tax. The main thing I wanted to convey here was how it hits your general ledger, meaning what it's affecting is your AR does include the sales tax. Your revenue is not including the sales tax, and you have your separate sales tax liability. Sales tax makes sense.
So, sales tax agency is just like another word for account, or they?
It's who you're paying the money to. It's a vendor, is really what I'm set up as, because you're going to end up paying Pennsylvania as a vendor. You're going to cut a check to them for a certain amount of money. So just like accounts receivable, you want to know who paid, who owes you money. Sales tax, you want to say who you owe money to. When we talk about things next time about migration, we'll talk more about migration. There are things that are very important to know who. You need to know who you're expecting money from. On the AP side, you need to know who you're paying money to. And for sales tax, you don't just want to know that I have sales tax payable of $1,000. You need to know that I have a sales tax payable of $500 that goes to PA, $200 goes to Philadelphia, and $300 goes to New Jersey. So you need to know how that's broken up. And on your chart of accounts, when you look at your balance sheet, it doesn't break it up that way. That's where you'll have more detailed reports for sales tax reports, for AR, for accounts payable. That's where you see your open payables, your open receivables, or your sales tax, of course. Sales tax gets more complicated that I won't get into here in terms of how they calculate how much you owe. So if you look at accounts receivable, I will touch on it. If you look at accounts receivable and accounts payable, you know how much you owe because you have payments that were applied to invoices. With sales tax, it does get a bit more complicated because when you cut checks to the different agencies, they don't apply it. And then sometimes they'll give you refunds or discounts. So sales tax really is just a running total of how much you owe and how much you don't. And there are some things with timing that also mess with the reports a little bit. That's behind the scenes. So if you are building something to calculate how much someone owes for sales tax, it's probably a little bit more complicated than accounts payable. So you should bring that up separately. Other questions on sales tax? Last topic of the day. Inventory. Let's start. I think it all the way through. You have that pen right there, right? I saw that in the deck. $15. Okay, for $15.
Sure.
All right, go ahead, sell the pen. All right, so what transactions did that just create?
There was a sales order and purchase order,
Okay, now we invoice them for the $15. What did that create?
a invoice and a bill.
And what general ledger accounts did it hit?
It hit accounts, receivable for him and accounts payable
So for him, accounts receivable, what else?
in revenue.
Right. And for him, accounts payable, what else?
Liabilities.
But, yeah, an expense. of some
Accounts
sort.
payable is the liability, what's the other side?
Expense. Or unless he's selling it
Maybe.
again.
That's the inventory, right? So last time we just went through some of the pen, we said it was accounts payable and expense, right? So it's a pen. Nick, it's a pen sales. Do you ever want to get a
$20.
So you ever want to get a job as a salesperson, you have to watch the videos on how something.
That's all pen.
That's all pen. So Nick is a pen salesman. So now, that pen is not an expense because he's selling it. That pen now has value. How much do you say your pen's worth? 20?
Yeah.
Okay. So we're going to look at this from Nick's perspective. He just bought a pen, so he received a bill for $15, is what we said, right? So AP increased $15 as a credit. You paid with cash. So your bank account is going to be down $15.
Well, then it wouldn't have been an AP, right?
What's that?
If he paid for it already, then it's not AP anymore.
Oh, yeah, you're right.
Pay with credit card.
No, he paid on the
Yeah,
terms.
AP, $15, so you didn't pay it.
Right.
So now, it's not an expense. What is it? It's inventory.
Yeah, so it's,
So inventory. Nick now has $15 of value. Because he wouldn't have bought that pen for $15 if he didn't think it was worth $15. So as of right now, this is a debit, it's valuable, this is a credit. That's the transaction that just took place. So if I look at my inventory asset, this is going to hit an inventory asset account. I have $15. Makes sense, everyone knows. Okay, good. Nick, sell the pen. Nick just sold the pen for $20. Well done. So you just created an invoice, right? What transactions got hit by the invoice?
AR.
AR, that's easy. $20. What else? Revenue. $20. What else?
The inventory asset.
Yeah. How much value in pens do you have today right now? None. So my inventory asset went down by $15. Which is a credit. Is that it?
No, you're missing the 5 now. Or,
Yeah, what the heck just happened?
So it's,
So now,
it says profit, you know, it's,
so this is cost of goods sold. The cost of the good that was sold. So what happens is COGS is going to be the cost of that pen was $15. Right? So my cost of goods sold is 15, my inventory is 15, AR and revenue 20 and 20. It now balances out. These cancel each other out. So now, I mentioned cost of goods sold when I talked about the profit and loss report. The whole purpose of the profit and loss report is to figure out, in here, my profit and loss is my revenue of $20, and it subtracts out my cost of goods sold of 15, which equals $5 profit. So if I didn't have my cost of goods sold account, I would have thought I made $20. I would have thought I was $20 profitable, but in fact, I was only $5 profitable. Right? So your cost of goods sold is the cost of what you just sold. Here's a final thing I'll leave on today, is the timing matters. So what happens is when I bought this pen, and this was on January 1st, and this was on today, my cost of goods sold doesn't get affected until it's sold. So that's why you'll see cost of goods sold is typically on sales transactions. Because at the time you sell it, because I'm not $15 in the hole on my profit until I sell it, because then I know how much I sold it for. So at the time you sell inventory is when it figures out how much was that thing worth that you just sold. And what we'll get into next week is I just made life really simple by having one pen that I sold. Let's imagine I had 50 pens. I bought some of them for $10, some of them for $15. Well, now how much is that pen that I just sold worth? That's where your first in, first out average cost, your FIFO, LIFO, all of that comes in. So I won't get into that now. But this is kind of a stepping stone. You need to understand when I sold it, how much is it worth? If I have one pen ever, it's very simple. It's whatever I just bought. Any questions? Does everyone feel like they learned a little bit more about accounting today than before you did it? Yeah. Good. Thank you. That's it. Talk to you next week. We'll get more.